You've probably heard the saying,
are you buying the dip?
Buy the dip.
Buying the dip.
Stock to dip buy.
but what if I told you it's time to put that strategy to bed? Research shows there's a better way. At the beginning of this month, close to $10 billion was poured into stock, signaling that enthusiasm for investing hasn't gone anywhere. But if you were to look at price trends, it isn't obvious what the markets really want to do. The S&P 500 has just started to recover. And if you're like me, you're probably giving it this suspicious side eye because I've been hurt before. The last thing you want to do is buy in heavy right before a dead cat bounce. It's not clear whether the brave investors entering the market, including crypto, will be rewarded for their trouble. But then again, sometimes it works. Anyone who bought in on a 10% dip in stocks for the last 80 years has seen an 81% return 12 months later on average. I was one of those people. I did a ton of analysis and dumped my entire bank account into 3 stocks on March 20th, 2020. Thanks to some luck, that was probably the single best day I could have done that. By the way, if you want access to all of my future stock and crypto buys, free coaching, and a ton of additional content, make sure to join my Patreon link down below. Members will tell you there is really nothing like it on the internet. Now, it stands to reason that people bullish on the markets would see red days as discount buying opportunities. But what if I told you there's a whole lot more that you must consider here? Whether you have positions in crypto, stocks, or other traditional finance products, it's important that you see this period for what it is, a time of financial stress that will come to define the next 5 years. This means strategies that worked when the markets were trending up aren't going to work the same today, and will likely have different results depending on your investment time frame. War, supply chain shortages, labor shortages, and interest rate concerns all paint a picture with about as much clarity as an age-restricted Twitter page that this isn't 2020 part 12. Because if the Fed isn't careful, this could be the return of 2008. If you're watching this video, you're probably one of the investors that decided to buy in November 2021 when the S&P 500 dipped like 2%. Records were set that month with a reported $2 billion of securities purchased. However, based on the losses we've seen this year, I have some questions. But first, I need to tell you about the commission-free, cow-themed trading app sponsor of this video, Moomoo. Moomoo offers tools to help you better identify investment opportunities. This includes the ability to track institutional investors so you can see what the whales are up to. You can join their free investing courses in order to better understand beginner and advanced strategies, view news right on the app, and have a handy market heat map, which is awesome if you're a visual person like me. And even better, Moomoo is giving my viewers a limited deal to receive up to 5 free stocks when opening a brokerage account and making a deposit. You get 1 stock for opening an account, another for any deposit, and 3 more for deposits over $2,000. So use that link in the description and get your free stocks before the offer ends. First, let's look at the strategy that degens love to yell about: buying the dip. It's a respectable rally cry for investors who might be thinking of selling to prevent further losses. I mean, it's better than the alternative of smashing the panic sell button at the worst time possible. Instead of freaking out, investors train themselves to bite the bullet and treat the dip as an opportunity. You can actually kind of twist your brain to be somewhat excited for red days because it means it's time to go shopping. It's possible. I've kind of done it myself.
You smell that? What is that?
Opportunity.
And this study seems to back this up. At first, it acknowledges that people who time the market right, buying right at the bottom, make big money. But it doesn't stop there, because failing to buy at the bottom would have netted you greater losses than any other strategies in this study. See, the odds of anyone buying the lowest day possible is unlikely. I mentioned my lucky pandemic buy a minute ago. If I'd purchased that just 1 week earlier, my returns today would be 50% lower, and I would have seen my position drop 30% before seeing any gains whatsoever. Eventually, I would have ended up in the green, but not after a bit of heartache and wallet ache. This study offers a solution. They recommend buying in 25 days after the market drops 10%. The average gains here are about 61% 12 months later, not as great as that 81% figure we mentioned earlier. However, the average loss in the first month is only about 3.6%. This dramatically lowers the risk of you buying in and then having your heart and wallet broken a week later. These insights are backed up further through research done by MarketWatch. Your results really depend on how well you can time the bottom, leaving a lot up to luck and your mental fortitude to weather any dips in price. Data says following that 25-day rule is a safer way to hedge against further volatility following big market crashes. Now, this isn't financial advice, and while most financial advisors would urge you to never try to time the market, there are tools that you can use to help figure out where the market may be headed. We shouldn't act like buying the dip is a hopeless cause completely. For this, Keith Lerner has some indicators. The first is looking for spikes, big dramatic upshots in the put-to-call ratio of stocks. This helps us tell the general mood of the market. A lower ratio tends to mean sentiment is expecting the market to upswing, which in turn means it's more likely that there's an uptick in investors buying in. Of course, we could also look directly at trading volumes. Lerner points out that a big spike in volume while the market is in decline could mean that the market is set to swing back upwards. I'll link an article below that explains further how to use volume. But it's important to note that while an indicator may provide additional insights, they are far from fortune tellers. Any effort to try to time the market comes with a substantial amount of risk. But let's look at the bigger picture here. For many, buying the dip isn't just a one-off buying opportunity, it's a lifestyle. It makes up their entire strategy. It's when we compare this strategy to others used by long-term investors that we see some surprising insights. This study compared lump sum investing with dollar cost averaging. With DCA, you set regular intervals to buy into the market, actually ignoring the price and maximizing your returns by holding long-term. You purchase the same in all markets, whether they're trending up or down. You aren't waiting for quote-unquote discount prices. Lump sum investing, on the other hand, is piling up cash and buying in all at once. The experiment analyzed the performance of several $1 million portfolios, comparing their profits over a rolling 10-year period. The portfolios were split into three categories: 100% equities, a 60-40 split of equities and fixed income, and 100% fixed income or bonds. The results were surprising. The lump sum portfolios, buying all at once, did better than DCA equivalents 75% of the time. But why is that? It makes sense when you consider one key dimension to this study: cash positions. For dollar cost average portfolios, the investor was sitting on stacks of cash for longer while spreading out their buys, hoping to smooth out the price of their investment. Cash doesn't pay. Thanks to inflation, it actually goes down in value. This also means dollar cost averaging is just as good as lump sum investing if you're investing your available cash every month. The issue comes when your cash isn't working for you. If you really want to grow your wealth long term, the best thing seems to be to just get your money working as soon as possible. Doug Ramsey's 25-day rule has its merits. If you're looking at buying into a market at record low prices, you now know about how long you could wait for a safe zone. All of this research really told me two things. First, time. With a long enough time horizon, none of the strategies we discussed lost money. So really we're debating between good and better. That's a good problem to have. Time in the market is what matters most, and investing sooner than later is generally a good idea because most years have positive returns in the market. Second, psychology. Ask yourself what you can mentally handle. Like seriously, ask yourself. Maybe dollar cost averaging doesn't offer the highest possible return if you have cash sitting on the side, but if DCA is the difference between you getting good sleep at night or not because you're not worrying about your investments, then it still might be a superior investment strategy for you. So take this information and use it to be a more confident investor. I'd like to thank you for watching. I'm Max Maher, and I hope you have a profitable day.